Most retirees lose thousands of dollars to the IRS not because they did anything wrong, but because no one ever explained this one home tax rule to them. They sell the house they lived in for decades, the house they raised their kids in, the house they paid off years ago, and then a tax bill shows up that they never saw coming. And the worst part is this: that tax bill was 100% avoidable. If you're retired, close to retirement, or planning to sell your home someday, what I'm about to explain could save you more money than any investment tip you've ever heard. Stay with me till the end of this video, because missing just one small detail about your cost basis, or the 2 out of 5 rule, could cost you tens of thousands of dollars. Before we dive into the trap the IRS has set for long-term homeowners, subscribe to Tax Hack Pro. We follow the money and the legislative shifts that the mainstream media refuses to audit. If you want to protect your retirement and your peace of mind, you need to be part of this community. Hit that subscribe button now so you don't miss the next deep dive into the rules that protect your wealth. The most critical thing to understand is that the IRS does not view your home simply as a place of memories. They view it as an asset with a cost basis. Most people assume that if they've lived in a home for 30 years, the profit is automatically tax-free. That is a dangerous myth. While there is a generous exclusion, it has strict limits and even stricter timing requirements that catch thousands of seniors off guard every single year. The $250,000 and $500,000 ceiling under current IRS rules for 2026, when you sell your primary residence, you can exclude a specific amount of profit from capital gains tax. If you are single, you can exclude up to $250,000. If you are married and filing jointly, that number is $500,000. This sounds like a lot, but think about the math for a home bought in the 1970s or 80s. If you bought a modest home for $50,000 and it's now worth $750,000, you have a $700,000 gain. For a married couple, $500,000 is tax-free, but that remaining $200,000 is fully taxable. Depending on your income bracket, you could be looking at a tax bill of $30,000 to $40,000 just because your home appreciated too much. The 2 out of 5 year trap: to qualify for this exclusion, you must pass the ownership and use tests. You must have owned the home and lived in it as your primary residence for at least 2 out of the 5 years leading up to the sale. This is where retirees make a fatal mistake. Many seniors move into an assisted living facility or a smaller apartment, but keep their old family home as a safety net or a rental. If you wait more than 3 years to sell after moving out, you no longer meet the 2 out of 5 rule. The IRS will then treat the entire profit as taxable. You could lose your $500,000 exclusion simply because you waited 1 month too long to put the house on the market. The step-up and the surviving spouse benefit: if you are a widow or widower, there is a special window of opportunity you need to know about. You can still claim the full $500,000 exclusion if you sell the home within 2 years of your spouse's death. If you wait until year 3, your exclusion drops to the single filer limit of $250,000. However, there is a tax hack called the step-up in basis. When a spouse passes away, the cost basis of their half of the home, or the whole home in community property states, is adjusted to the fair market value on the date of their death. This can effectively wipe out decades of taxable gains instantly. If you don't know how to document this step-up, you are essentially leaving a massive check on the table for the IRS to collect. If you are realizing that your largest asset is actually a major tax liability, you need to subscribe to Tax Hack Pro right now. We break down the fine print that protects your equity from being drained by outdated assumptions. Improvements versus repairs. The paperwork war the IRS allows you to increase your adjusted basis by adding the cost of major home improvements. A new roof, a kitchen remodel, or a swimming pool adds to your basis and reduces your taxable profit. But here is the catch: repairs do not count. Fixing a leaky faucet or painting a room is maintenance and provides zero tax benefit. You must keep receipts for capital improvements that add value or extend the life of the property. For most retirees, these receipts are buried in a shoebox or long gone. Without that paper trail, your profit looks much larger to the IRS than it actually is. The 2026 ripple effect. Medicare and Social Security: what most people miss is how a home sale affects your other retirement benefits. Even if the profit is excluded from capital gains tax, any taxable portion increases your modified adjusted gross income, MAGI. In 2026, a high MAGI can trigger the IRMAA surcharge on your Medicare Part B and Part D premiums. This means the year after you sell your home, your monthly healthcare costs could double or triple. Furthermore, if the sale pushes your income over certain thresholds, It can make up to 85% of your Social Security benefits taxable. This is the hidden tax that turns a profitable home sale into a long-term financial headache. You need to be the watchdog of your own equity. Don't let your American dream be derailed by a lack of information. Take control of your basis, understand the 2 out of 5 clock, and stay one step ahead of the bureaucrats who are looking for reasons to flag your return. If you want to ensure you never fall into these retirement tax traps, you must subscribe to Tax Hack Pro. Knowledge is the only way to keep your hard-earned money in your pocket. We provide the forensic audit of the rules that affect your life, your home, and your freedom. Selling your home should be the gateway to a comfortable retirement, not a mandatory donation to the IRS. Share this video with every retiree or homeowner you know. You might just save them $20,000. This is Tax Hack Pro, and our audit of the home sale tax trap is just the beginning. I'll see you in the next investigation, where we expose the foreign pension offset that is catching thousands of immigrants and green card holders off guard this year. Stay sharp.